Those who attempt to short the market generally lose. As the Fed has taken the other side of the equation, it has been a very big hurdle to overcome. How can investors predict a downturn in the stock market if there are trillions of dollars floating around looking for a place to go? Well, it would seem that some bubbles are worth shorting. Well, at least according to some. Michael Burry from The Big Short has not only been shorting Tesla, not only calling out the bubble in the stock, but adding to those shorts. This could be one big mistake or one very profitable trade. You came here for the truth, so let me unveil that for you. Today we're going to talk about Michael Burry, The Big Short. I'm going to show you what's been happening there, give you a little update. I brought it up in previous videos. We're going to talk about the irrational exuberance that is in the markets today. I want to show you what others have been saying, some of the analysts out there, give you the data corresponding to that. I've got some economic factors as well, so let's get into it right away. Out of Market Watch, Big Short investor says his big Tesla short is getting bigger and bigger. He was made famous for shorting what happened during the financial crisis, housing crisis. He was calling it out during a period in which very, very few were doing so. You got to give him credit for that. Doesn't mean that every single thing he says is correct. Doesn't mean that every single action is going to be the next big thing. Absolutely not. But he is an interesting character. It is interesting to see what he says, what he does. It's all made public, so then we can see what happens in the medium in the long term. Tesla short sellers caught on the wrong end of a $38 billion hit in 2020 suffered the largest yearly mark-to-market loss that they've ever seen. One of those underwater on that trade, Michael Burry. So let's be clear, right now he's losing out, but as the stock goes higher, he's actually putting more in. Now you might be doubling up on a losing trade. We'll see, at least at this time, not necessarily in the short term as you see right here, but it's going crazy. I mean, I have the chart underneath here, but it's just absolutely parabolic at this point here. The investor made famous in the book and film The Big Short for his prescient bet against the U.S. housing market announced in early December that he was shorting Tesla at ridiculous levels. He was calling it out, making it public, was making it known, and it is just something to behold because the stock has gone straight up. It's been ugly for Burry and the rest of the shorts since then, with Tesla shares up more than 44% in the past month. Over the past year, the stock has exploded for a gain of 820%, making CEO Elon Musk the richest man in the world. On Friday, Tesla stretched its record-winning streak to 11 sessions in a row, closing with another record. The stock's going up like crazy, but what are the fundamentals behind it? Does that even matter anymore? Some say no. When will it stop? Tesla keeps charging higher as shorts continue to bleed. As you can see right here, that blue line, that's Tesla looking at this through 2020 into where we see in 2021. And the actual stock market, the S&P 500, has performed very well over this period. I mean, you know that. I know that, but when you compare the two, it looks like the S&P is a flat line. That's the difference between these. I mean, it's been unbelievable to see how this has progressed. Just showing you, giving you an idea of where we are at in percentage terms. Tesla, the blue line, going up. I mean, I just read it previously. We're looking at 800% over that period. And you see the S&P 500 basically non-existent when you compare them. That's how just over the top this has really been. There are a few things here, but I just want to highlight one point. Now only 1% plus 10-year yields could crack the tech bubble in the same way as 3% plus yields did in the fourth quarter of 2018. I don't know what's going to happen, but certainly when I see something occur time and time again, it is something that should be really raising a red flag. Looking at the tech stock valuation conditions being fragile, they give us some statistics here. So I'll read the top one we're looking right here. World Tech 12-month forward earnings yields minus 10-year T-bond yield. And that corresponds to these periods of time when we're matching it up with this one here is world equities, and this is the 10-year T-bond yield, trying to just show us that throughout these periods, you overlay this information and it really correlates. So what they're trying to suggest here is that based on what we're seeing right now, might be hard to see, I know, but we may have a big problem coming up. Now, the Federal Reserve wants to implement something called yield curve control. They're not the only ones to do this. Other central banks do this. They try to do it, and ultimately doesn't have a positive effect. They are trying to control what happens. But let me just give you the lowdown on what that means. That means more QE. That means they're going to expand their quantitative easing policy, do it in a different way on top of what they're doing, of course, and ultimately manipulate the market further. They are actually actively looking at these different charts, these different indicators, these different, I don't want to say predictions of what's to come, but ultimately they see these things too. And they have obviously their finger on the pulse, know exactly what's going on. So they are trying to not fix the underlying issue, because they can't, quite frankly, but they can certainly fix the symptoms. Oh, you're having a problem with that? All right, no issue there. We'll just paper over it. And that doesn't work. That has never worked. But of course, this is what the central bank tries to do. They see these indicators getting all wacky. They're going to go in and try to manipulate them. That, to me, very worrisome. Although monetary policy had been ultra expansionary even well before what we saw in 2020, central bankers are currently upping the ante once again. While it took the Federal Reserve almost 6 years to create $3.5 trillion in new US dollar liquidity, this time around it took only 10 months to unleash a monetary tsunami of $3 trillion, with the projection of at least another $1.8 trillion next year. Many have projected the balance sheet of the Federal Reserve to hit $10 trillion in the near future. This would be very historic, but really, based on the trajectory, doesn't seem like it's much of a surprise. To give you a quick update on the Fed balance sheet as of this week, actually the last 2 weeks, I noticed that the balance sheet had declined and then declined again. So week over week, this is actually down, but obviously we're talking almost 7.4 trillion or something ridiculous like that. So at this point, I mean, who's even keeping count? It's kind of silly, but we're getting to a point in which what was there, QE1, QE2, the whole world was saying, oh my goodness, quantitative easing, this is crazy, this is so huge. They're printing hundreds of billions of dollars. Then they started in 2020, started printing hundreds of billions of dollars in such a short period of time. At one point they were printing, what was it, $125 billion a day or something ridiculous right at the peak of that. And then they went on to suggest to the public that what they're doing is promoting price stability and promoting full employment. It's so ridiculous. It's so upside down, but people will take it in because they buy Tesla stock. They buy all of these high flyers, and they need that to continue. The only way that it's not going to go down, as we learned in 2018, we learned the lessons of what central banks are doing in 2018. There was enough evidence there, and I've said it since that point, and I've said it hundreds and hundreds of times since. The correlation between the central bank balance sheets and what you see in the stock market is going to continue until something breaks it. That's the way it is. 2018 balance sheets started to fall globally on a global level. You saw the stock market fall 93% of assets total start to drop. You look at what happened near the end of 2018 into 2019, balance sheets start to expand. Guess what happened to the stock market? Of course, this is not just some random event. It's not just a one-off thing. No, they are directly and completely correlated. One fulfills the needs of the other. Take a look at this. I mean, I've been covering it here on this channel. I talked about it in my book. You could see what's going on in Europe. 10-year government bond yields for Portugal and Spain. You see where that spike is? That was the euro sovereign debt crisis, the euro viral contagion, as I refer to it. You could see the green, that's Portugal. The black is Spain. Ultimately, yield in percent, I mean, that peaked out for Portugal probably, it's hard to tell, right around 14%. Okay? And now today, both of these are effectively at around zero. That's what we're dealing with today. Even though the risk hasn't gone away, you're supposed to get yield because you're taking on that risk. You're supposed to get a return based on the fact that, this is a risk. I'm giving you money here for 10 years. I don't know what's going to happen over a 10-year period, but I'm going to get a return. Okay, good. I'll take that risk reward scenario. Now your return is zero, and you also have to wonder what's going to happen over a 10-year period. Unbelievable, truly unbelievable, but that's where we're at today. This is what's happening to the value of money. This is an article that I thought was interesting. They mentioned quite a bit in here, and I believe the next one and the one after. I'm just going to quote a few things that I thought were interesting. It's a full-blown mania, and the bull's relative youth doesn't make it, quote, safer to climb aboard. All right? We're just as guilty as the others in chasing this momentum. So he's suggesting, look, we're doing it. We're also buying, but we're just pointing out the fact that it's ridiculous. And I think that is the case for many. They realize what's going on. They look at the analysis and they say, no, this doesn't make sense, but we're still going to buy. And I get that. I get why they're doing so. And definitely they have to worry about their bottom line. Too much froth, too much complacency. That's another quote there. After a 16% rally right here in just 2 months and a 70% rally since March, that news should have knocked down the market. A 10 to 15% correction would be normal and healthy. That's the reason why I mentioned this quote. It would be good to see the market come down 5% here, the next month after a few percent again, but it doesn't do that. It only goes up. And when you see that, it's always dangerous because it doesn't go up in a linear fashion. It's always doing one of these. It comes down just a little bit and then it goes even higher, and then it goes down just a little bit and then it goes even higher, and then straight up, a straight line upward. It keeps getting worse and worse and worse. And this goes parabolic. And of course, that never ends well. You don't have a crisis because, something just fell apart, on a daily basis. You get certain events that occur. Okay, they're having a lawsuit here. Okay, they're having some troubles here. No, things have a crisis. There's a collapse because of all that speculation that's built up, and suddenly nobody wants to be on the other side of the trade. There's always two sides to a trade. I think people need to realize that. And unless the Federal Reserve is going to make sure that they buy the actual stocks, then we've got a serious issue. I don't know if necessarily the Federal Reserve wants to buy the whole market. We'll see. Initially, I was going to run through a lot of this article here. It's too long. I might not be able to get to a lot of it, but just let me touch on a few points. This is talking primarily in this article about what's happening in emerging markets and seeing the effect of everything that happened in 2020 on their economies, but I'll touch on a couple points. Analysts call it a debt tsunami. National accounts are sinking into the red at record pace. I consider the risk to be very high of an emerging market debt crisis where a lot of countries run into problems at once. This is going to be a rocky road. By the end of 2020, total government debt worldwide is projected to soar soar by $9 trillion and top 103% of global GDP, a historic jump of more than 10 percentage points in 1 year. Countries have maxed out their credit cards to buy medical equipment, doing things for hospitals and healthcare and so on. They cannot keep up. And it goes on to tell us that, the IMF and the World Bank have stepped in to save the day. That's right. The IMF is always there to save the day. We want to just extend a thank you and maybe a little golf clap. A little golf clap for the IMF. Let me just continue on that golf clap for a second. That's right. Okay. Enough with the sarcasm. All right. Look at the different countries here in this list. I'm going to talk about Angola, what they're dealing with. They've got to go out and actually start to get money from somewhere, start to get it because it's not coming in. The revenue's not coming in. They talk about Costa Rica in here as well, going down. They just mentioned a few others, Zambia, another one. They talk about the issues, but I think it's pretty clear that this problem is not just in one place. And you look at how many economies are struggling, but the stock markets, even in so many places where the economy is just completely crushed and it will get worse for 2021. The markets are still increasing. That is never a good sign and historically quite an anomaly. You remember the Paycheck Protection Program? Yes, that's right. Everybody loved it. I mean, you had to help out the small businesses. You had to help out the individuals. These people really needed it, right? Well, it turns out that the big businesses got most of the money and the little guy got nothing. I kind of get a little bit of deja vu there. The Paycheck Protection Program was a lifeline for millions of small businesses brutalized by the issues of 2020. Over a 4-month span, the government program distributed $523 billion in forgivable loans, that's taxpayer-funded bailouts, to more than 5 million companies. The average recipient got just over $100,000. Okay, good stuff, right? Well, read on. Let's read on here. And then there were roughly 300 businesses that received loans of $99 or less. This particular person, $27. This one, 96, 78, and a chiropractor in Texas got $1. $1. This person here, $13, and the quote is, "That's supposed to help my business? It was a joke." Look, when you're trying to do things top down, it doesn't work. The big government, it's not working. What they tried to do, quite frankly, didn't help out many people who actually needed it. And as a result, last I checked, 110,000 businesses, and I'm forgetting what that includes exactly, but 110,000 businesses definitely have closed down. That was totaled up not that long ago. I think the numbers were December's numbers. So we can see that, quite frankly, you can give people forgivable loans that might delay the inevitable, and that's just about it. Just 39% of Americans could pay for a $1,000 emergency expense. Fewer than 4 in 10 people have enough savings to pay for an unexpected $1,000 expense in cash. Of course, you know what's going on today. I mean, come on. The average person doesn't have the cash, especially as I've shown you in the last couple videos there, where we're talking about the fact that as time's going on, people haven't been paying their rent, they haven't been paying their mortgage for many people, for millions of people, and that is just adding up, and that total needs to be paid back at some point. If those individuals go bankrupt or what have you, what's going to happen to the landlord? Same situation. They go bankrupt. Then what happens to the lender? Then they have problems as well. So of course, this is something that is just continuing, and I'll keep covering it as time goes on. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. Simply by clicking a button on your screen, you help the creator of the video. Thank you. If you want to learn about e-commerce, you are interested in selling stuff on the internet to make some money, you could learn for free. I teach you for free at the AmazonGPS.com. If you are interested in the financial system, you want to know what's actually going on. Maybe you know, but a member of your family and so on, they need to know. Check out these 2 books. I know that they will be so helpful to you, so easy easily explained in here. Definitely check them out. You can flip through them for yourself at the link in the description. And if you want the audiobook instead, themoneygps.com. Hey, hold on, don't go anywhere. Have you seen this video yet? If not, you definitely want to watch it. Click it. I'll see you there.